Hello, this is Victor with Victor for Advice. Today I want to talk about why the infinite banking concept is the best way for you to be able to live your life debt free. Now, you have many gurus out there like Dave Ramsey, probably being the most famous, that wants you to live your life debt free. But the formula that he uses, the method that he wants you to follow in order to live your life debt free, is extremely difficult for the average person and the average family to follow. It just it's just not going to happen because you see, we need funding for most of our lives. Living a life completely debt free is extremely difficult and in many cases impractical and not efficient. So let's give you the Dave Ramsey method before I get into the illustration you see here. The Dave Ramsey method is uh, you get a little savings account, going for a rainy day, maybe $1,000, and then you start saving money and taking the any excess you might have, which means you have to change your spending habits drastically, which I don't have a problem with for many people because you need to do that. And let's say you have an excess of $500 a month, and now you take that $500 a month and you pay it onto that first debt. If it's a $50 a month payment, now you're paying 550, and you pay that off and you roll that over and you get the snowball effect. So you finally get out of debt. That's great. Now he wants you to continue living your life out of debt. So if you want to buy a car, what do you have to do? Well, you're going to have to save your money every single month now that you're out of debt, and for years, until you have enough money to buy that new car. Then you buy your new car. Now are you at? Well, all that money you saved up, you don't have any money left. So now you got to begin saving up again for the next car and the next car. One, if you want to buy a vacation on cash. Let's suppose you want to buy a refrigerator, or you want to buy a lawnmower, or you want to do an improvement to your house. How in the world are you going to do all these things cash? Do you see where I'm coming from? You just can't do it. So you're going to stay in debt. I would love to see the statistics of how many people got out of debt with the Dave Ramsey method and stayed out of debt for the rest of their lives. So I'm going to give you a better example. You're still going to have to be a saver. I mean, if you can't save money, if you just can't adjust your budget, if you can't find any money anywhere ever, then you are not a candidate for infinite banking, nor are you a candidate for the Dave Ramsey method, or are you a candidate for even creating any kind of wealth. You're going to be a slave to debt for the rest of your life, and you're going to retire one day, and hopefully you have some money in a 401k and Social Security, and that's where you're going to be. But if you can save money, you can learn how to be debt free in a lot better way than using the Dave Ramsey method. Let me give you an example. Let's go to this illustration. And I'm going to show you two different illustrations. This is a lady here, one of my clients, that from a while back works for the government, makes decent money, but she's very frugal, saving because she has a plan to when she gets ready to retire, she's going to have a lot of wealth. And she's willing not to live a super extravagant life now and, be a saver. So she's got some money saved up for her future wealth building, and she wanted to find a way to put this money to work safely. And infinite banking, she came across infinite banking. She came across my videos, made sense to her, and we ended up doing business together. Now, here we go. So she had money, and she's putting in $20,000 a year for 4 years. And after that, she's just dropping to $3,000 a year which is what, not much, $250 a month or so. It's about it. Um, Now, when we designed this, we designed it so that she was able to, we have here a MEC of $20,000. So she could put up to $20,000 a year every year she owns this thing, but she's not obligated to. In fact, she's not even obligated to do the 20,000. See up here, she's only obligated to pay $1,947 a year for the base policy of 127. The rest goes in cash. So you see in the first year she drops 20,000 and she has total cash value in it. She has $17,000 she has available. She dropped 20 grand immediately. She has 17,000 available. So what happens at the end of 5 years? She's sitting on $84,000 in cash. Now that's her bank at this point. See, folks, she saved money, and now she's got this 84,000 it's building, and it's going to continue to go up. And now, can she live a debt-free life with $84,000? Well, she can finance a pretty nice car, $40,000, $50,000 car, paid off in 3, 4, 5 years, like she would, or 6 years, like she would, paying it to a bank. She could finance refrigerators or lawnmowers or something in the house. She could buy a fixer-upper, get it fixed, turn it, flip it, put the money back in. Hey, there's a lot of things she can do with $84,000. And she doesn't have to continue to save it for the rest of her life. Why? Because this is going to continue to go up. Look, what I did here is I made it so that after year 10, she's reduced, paid up, doesn't ever pay into it. There's no more cost coming out of the policy. Reduced, paid up means no more cost. It's just a pure cash machine. In fact, from year 11 to year 12, this account goes up over 5%. So she's got total cash value in year 11 at $127,000. She's done, folks. She's done. She doesn't have to keep saving money, spending it down, saving money, spending it down. And she knows that her spending limit right now is $127,000. She's not going to borrow or spend more than $127,000 because that's what she has in her bank. So if she wanted to finance something for $50,000, she could just take $50,000 cash out of here and blow it. That would be the Dave Ramsey way. That would be dumb. Better borrow from it or against it. Let the insurance money lend you $50,000. You keep your $127,000 in there, earning interest and dividends. Pay back the loan, and when you finish paying back this thing, the loan to the insurance company is 5%. This thing's making over 5% a year. It's basically a free loan to you. Plus you got dividends and all. So your cash value, what happens is after you finish paying back the note, you have more money than you started with. You see, she's not putting any more money into this bank. Do you understand this? She borrows from the insurance company. They charge her 5%. She pays back the money, but this thing keeps growing and growing. So after she's paid back her note, she's got more money than she had before. You can't do that when you're doing the Dave Ramsey method, because if you save up your money, how much are you earning on your money? 1%, 0.5%. You spend it all down, you got zero. Here, her money is earning over 5%. She borrows, she takes a loan with this as collateral, pays it back, and she ends up 5 years later with more money. She can live the rest of her life debt-free. Well, and she gets to 70 years old here been borrowing and repaying and living debt free because she's really, well, Victor, she's in debt to the insurance company. But not really, because she doesn't have to pay it back. She can let that loan go. One of these days, the insurance company is going to get their money back when she dies. But she's going to limit to how much she can borrow, so she's going to be a good banker. She's going to pay it back. Same thing with Dave Ramsey. If you save money in a bank account, spend it all down to buy some, you're going to have to put more money back in the bank account, right? It's the same thing, except you've got money to show for it. So she goes to say, and she's been borrowing money, and now she's 70 years old, and she's got, in spite of all her borrowing, she's got $282,000 in her bank, pure cash. What if she took all this money here, folks, and spent it every time she wanted to buy something and have to start all over again saving this money? You see, folks, it just wouldn't make sense. Look, here's another example. This is just $6,000 a year. This is just $500 a month. This person did a policy for their teenage child, putting in $500 a month. Here's the child's age at the end of the first year. Drop in $6,000, you end up with $4,155 in the bank. Okay? By the end of 5 years, $30,000, right, has gone into the policy. You're sitting on $26,450, and you keep going. Now you can stop this thing at any time you want. We just ran this out for 30 years. The child is 46 years old. Didn't go reduce paid up because the child may want to put more money into it, but only $1,220 comes out to pay for the base policy. Heck, the dividends alone are $6,100, not to mention the interest. So this policy keeps cranking out forever. But after 30 years, listen to me, just putting in $6,000, just putting in $500 a month since she was a teenager, $500 a month. She ends up at the end of, she's 46 years old, she's got $378,000 in her bank. Cash. If she dies prematurely, her family gets almost $1.5 million, tax-free. She goes to age 70, she wants to retire, she's got $1.2 million, and she stopped paying on this thing when she was 45 years old. She's got 70 years old, $1.2 million. I don't know how much that'll pay tax-free, but that could pay her $80,000 a year tax-free for the rest of her life, maybe more. But let's go back to the borrowing. Now she's a teenager now. Okay, let's listen to me, folks. Look, listen to me, folks. This is so important. If you want to know how, if you want to learn how to live a debt-free life, I'm showing you. I wish I'd have known this 20 years ago myself. Let's say she's 25 years old. Okay, 25 years old. Young woman, 25 years old. Net cash value. She's 25 years old and she's sitting on $63,000 in cash. Do you get that, folks? $63,000 in cash. If she wants to finance a $25,000 car, does she have to go begging a bank to do it? Well, I've just got out of college and I'm just now buying my first vehicle. I don't have any credit. Does she have to worry about any of that? No. Now, what I'm going to encourage her to do is get that loan for that new car. Well, it's your first time buyer and everything. You're probably going to pay about 10%. I don't care because she's going to get that loan. She's going to make two payments, and then she's going to, because it's a simple interest loan with no prepayment penalty, she's just going to pay it off. Where she's going to call her insurance company and say, send me a check for $25,000. She's going to borrow against this money. The insurance company will send her $25,000. She will stroke a check, loan paid for, credit score goes boom, straight up. She's got the title in hand. No one can take that car from her, and then she can pay back the car at her leisure. She can pay back the loan at her leisure. Now, she wants to be a responsible banker, so it's probably better to discipline yourself and just put together a payment plan and pay it off in 5 years. Just send regular payments to the insurance company for the loan, and you're done. But you see, she knows that right now she has $63,000. That's her budget. Pretty nice budget, isn't it? And she knows that she can't spend any more than $63,000. So if she didn't have this in place, what would happen? She'd have to borrow $25,000. She would pay that interest back to a bank, and she'd have nothing to show for it at the end of 5 years except an old used car that's not worth maybe $2,000 or $3,000. Here, guess what? Her bank continues to grow. Now she's putting money into it, but her bank continues to grow, interest and dividends. And at the end of 5 years, she has more money than was in there before. Her bank has grown, and now her spending power has grown as well. She can go living the rest of her life debt-free now. And she's young, she's in her 20s, but she's got a whole life of debt-free living other than a mortgage. Right? Now, you're saying, Victor, but she's paying the bank. You got to understand this, folks. She could take $25,000 out of here and pay the car cash. That would not be smart, because now that $25,000 will never be grown again for her future. Remember, at 70 years of age, she's going to have $1.2 million. Just putting in $500 a month for 3 years, 30 years, and to stop paying, she could go paid up here, and then it would make even more money for her. So that's what she knows. So she says, hey, this is my bank. This is going to allow me to live debt-free, so I'm never a slave to anyone anymore financially. However, I want this to be my retirement account someday, so I can retire tax-free. In fact, when she gets, look, folks, do you think that when she's 30 years old and she's earning a nice income, let's say she's earning $80,000, $90,000 a year, do you think she may want to put more than $6,000 a year into this thing? Remember, she could put up to $20,000. You think, you know what? I'm just going to put $10,000 or $15,000 because I already know that if I just do $6,000 and then I stop when I'm 45, I'm going to have $1.2 million. And that's if the interest rates stay where they're at. I mean, if the interest rates start going up, I know I'm getting at least 4%, plus I'm getting my dividends, so the dividends always go up. You know, if the interest rates start going, so I may even get even higher dividends in the future. I don't know what that amount's going to be at, but if I put more than $6,000, maybe I'll end up in retirement with $2 million or more. Do you think she's going to be encouraged to put more than $6,000? Well, of course, because if she's does the average person do? When they're 30 years old, they're putting money in a 401k. Well, guess what? The infinite banking is her rainy day fund, is her bank, so she never has to borrow from anybody else. It's her 401k. It's her IRA. It's in her investment account because she can take that money and say, you know what? I've got let's see where, I've got $100,000. I've got an opportunity to buy this house as junker over here for $50,000 and fix it up for $75,000 and flip it. Make me 30 or 40,000. Now I wouldn't advise using all that money because there's private money and hard money out there where she doesn't even have to touch this, but she can use this for operating costs and carrying costs and things like that during the deal. And she can put a bunch of money in her pocket through that. She might get to a point over here when she's 40 years old, right? 45 years old, and she's sitting on 359,000, and she's got the opportunity to buy a franchise for $200,000. And she says, I'm in. Send me a check. No problem. No questions asked. She's got 359,000. The insurance company will send her a check for 200,000, lickety split. There it is. No problem. Here's my down payment on my franchise. Let me go to work. She starts producing income from that franchise, pays that $200,000 off in the next 4, 5, 6, 7 years. Done. Now she's got cash flow. Who knows? Maybe 6 figures from that franchise. Do you see the power of this? You can't do this the Dave Ramsey way. And this is just $500 a month. Most people out there, if they put their mind to it, most people out there, if they put their mind to it, can put away 500. You're already doing it at work. In fact, I'll be honest with you. This beats a 401k all day long. All day long. But here's how it helps you live debt free. Because if she's 25 years old, she's sitting on $63,000, she knows, hey, I can't borrow more than $63,000. In fact, I don't even want to be $63,000 in debt unless it goes into something that's paying me an income every month that's going to pay back the note. That's a different story. But she can buy a nice car. She can go on a nice vacation. She might say, you know what? I want to take a month and tour the world. It's going to cost me $10,000. Go for it. It's here. She can afford it. She just pays back that 10,000 bucks. If it takes her next 3 years to pay it, done. The money's there. She can do it. Will $63,000 cover any emergency? What if she becomes disabled at age 25? There's some money there for that. I mean, folks, you can start at 25, 30, it doesn't make any difference. If you can save some money, like Dave Ramsey tells you to do, save, 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 make room in your budget, take that money, pay down that debt. If you can save money, you can do infinite banking. And it's better than the Dave Ramsey method. Because over here, if you have $500 to put towards debt, don't put it towards debt to begin with. Put it in this infinite banking policy. You see here? So at the end, let's suppose you have you're $30,000 in debt. And to, 5 or 6 credit cards. And the first credit card you owe is $2,000. All right, well, so you put $500 a month into the policy, and at the end of at the end of the first year, you get $4,155 in cash in your policy. Borrow the $2,000 from this policy and pay off that first debt. Got it? Now, how much were you paying towards that first debt? Well, I was paying 80 bucks a month. All right. Now you put the $500 a month, plus the $80 a month that you were paying towards that debt and you put it in the policy, pay off the loan to the company. Use $80 to pay off the loan to the company. Remember, if you're paying credit card debt, it's probably 15%. So take the $80 and pay off the note to uh, the insurance policy. Instead, the credit card's paid off, and now you're paying it back to the insurance company at a much lower rate. So you knock off that debt, and then when that's all gone, you're ready to move on to the next one and the next one. And here's what happens, folks. Here's what happens. The Dave Ramsey way, you'll get out of debt. That's the snowball effect. I just explained the snowball effect. You will get out of debt, but what happens when you finally pay off that $30,000 debt and you get on the radio like it says, I am debt free? Great. You're debt free and you got $1,000 in the bank. Hey, congratulations, you stuck it out and got debt free, but you got no money. Okay? Now, guess what? Here, you're putting in the $500 a month. Here, you're debt free. Let's suppose it takes you 10 years to get debt free. And what happens at the end of 10 years? Whoa, $54,000 in this case. I don't know what it'll be for you. Get out of debt the Dave Ramsey way and end up with that little puny 1,000 or 2,000 in the bank that he has you do at the beginning, or get out of debt and have $30, $40, $50,000 in your bank, cash. Better yet, what happens if you're paying off debt in your year 6 and you die? Oh, in this particular case, it's $1.2 million of tax-free money goes to the family. We have a term rider drops off after year 7 for efficiency purposes, and you're bound down to $579,000 here in year 8. You die in year 8, $579,000. Would that take care of any lingering debt? Oh yeah. So folks, I wanted you to show you this because if you truly want to live a life that's debt-free and build wealth at the same time, wealth now and wealth for your future, infinite banking is absolutely, hands down, the best way to do it on practically any budget. Now, if you say, Victor, all I can do is $100 a month, I say, hey, look into your budget, work on it. Like Dave Ramsey says, get a part-time job, whatever it takes, so you can get $300, $400, $500, $600, $700 a month going into the policy. And just stick to it like crazy. Next thing you know, that bank is going to build and build and build. You'll get out of debt 3, 4, 5, 10 years down the road. I don't know how much debt you have, but at the end of it, if you stick with it, you're not going to be broke. You're going to have a bunch of money sitting there in cash. And you'll be good for the rest of your life. You'll be debt-free. You'll be in the habit of being a saver. Your infinite banking policy will grow and grow and grow. And one day when you get into retirement, you'll have a nice tax-free retirement on top of everything else. I hope this has kind of made sense of how you can use infinite banking to live a debt-free life, because it forces you to live in that budget of whatever cash value is all I can ever spend. But when you do it right, that cash value is substantial. $30, $40, $50, $60,000. The average person who's in debt up to here, you take away the mortgage, they're sitting on $20,000, $30,000 credit card debt, and they can't breathe. Even at $15,000 in credit card debt, some people can hardly breathe. Well, if you're sitting on $30 or $40 or $50,000 in your infinite banking policy, you got it. You got it. And it'll be sooner than you think. This is Victor Cuevas with Victor Advice. I hope this has helped you out. And hey, give me a call, contact me, email me. Let's see if we can make this happen for you. God bless.